Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes. I'm your host, Beata Manthey, Citi's head of global equity strategy. Joining me today is our senior equity strategist, David Groman. Welcome back to the show, David.
Thanks, Beata. Always great to be here.
David, markets have had quite a run. Equities are near all-time highs. We've had a blowout earnings season in the US, and sentiment has recovered sharply from the lows we saw around the end of March. But at the same time, there is still plenty of things to worry about: the Strait of Hormuz, interest rates, the narrowness of market leadership. So today I thought we would do something a little different and have a proper debate, the bull versus the bear case for global markets. I'll let you pick the side, optimist or pessimist.
Yeah, I'll take the optimist side, though I'll admit it's not the cleanest call. I think there'll be a good debate to be had here.
Perfect. So make the case. Why should investors feel good right now?
Yeah, so I guess I'd start with earnings because I think that's really at the foundation of everything bullish this year. So we've had a genuinely strong 1Q reporting season, particularly in the US, where, as you said, it's been a blowout quarter. And it's not just the US. We've actually been seeing global earnings upgrades basically wherever you look. Initially, these were concentrated into a few areas like tech and commodities, which made sense given the tailwinds from AI and oil prices. But over the past month, we've actually seen more EPS upgrades than downgrades in all but two global sectors. And that's left analysts penciling in a pretty astounding 25% global earnings growth this year, which would be one of the best years ever to not come off of a recession previously.
Fair enough. But what about the macro setup which underpins these type of earnings numbers?
Yeah, I think that's a fair question, but I guess what I'd say is that our base case is still that the Strait of Hormuz reopens sometime in July and that oil prices settle back in at around $90 a barrel by the end of this year. That's obviously still way above what we were forecasting coming into 2026, but it's also the type of environment where our economists aren't particularly worried about big downside risks to growth or big upside risks to inflation. And if anything, I'd say that recent press reporting, some comments from political officials, has lifted hopes that a ceasefire could be coming sooner rather than later when it comes to Iran. And then on top of all of that, our house view is also that US rates are going to come down pretty meaningfully by the end of this year, with 10 years settling in around 3.75%. And that compares to around 4.5% where we are right now. So what I would say is that if we get all of these three things playing out, so that's solid earnings growth, it's geopolitical de-escalation, and it's lower interest rates on top of it, you've got a pretty constructive setup for global equities to the end of this year.
Okay, so that's a reasonable bull case, I have to say. But let me push back because I think there are some real reasons to be cautious here. The first one I'd flag is the narrowness of what's driving the markets. Yes, earnings are strong, but tech and commodities are still doing the heavy lifting, while consumer sectors in particular are being driven by downgrades. That means solid global EPS growth, but it's still going to be propelled by a small set of sectors. And historically, narrow markets tend to come with more volatile trading conditions.
Yeah, that's fair. And it's obviously something that we've been watching closely. But don't valuations already reflect this gap or this narrowing in the earnings trends?
Well, not necessarily. Value sectors are still trading at some of their highest multiples over the past few decades. And that means there is very little margin for error if earnings do disappoint. But at the same time, the macro risks are still skewed to the downside if the Strait of Hormuz stays closed longer than expected. Our commodity strategies still see a 30% chance of oil prices averaging $130 per barrel in the second half of this year. And that could be a world where global growth falls below 2% and inflation stays elevated, which would be a very difficult environment for equities.
Yeah, makes sense. So what about rates here? Because that's another headwind that a lot of investors have been talking about recently.
Yes, while we've seen some relief lately, interest rates have been rising again this year. There are some idiosyncratic drivers like the UK, but this has been a coordinated rise in bond yields across the world. I don't want to overplay this because the relationship between bonds and equities is nuanced, but what I will say is that our work in the past has shown that equities can do well when bond yields are rising, but usually that's because higher yields are reflecting solid macro conditions. The worry this time is that rising yields reflect worries around inflation or policy. And again, that would typically be a trickier environment for equities. David, let me bring up one more thing, which sits between the bull and the bear case, and that's sentiment. How bullish is market sentiment right now? And can we put it into historical perspective at all?
Sure, yeah. So after the sharp recovery that we've seen in markets just over the past few weeks and months, some of the sentiment indicators that we watch have moved into what I'd call frothy territory. So our favorite tool for this is our proprietary bear market checklist. And in the BMC, what we do is we monitor 18 different factors to see if the conditions are in place for a long and sustained equity market drawdown. This is particularly helpful because we can compare this to the past, right? We can look at what the BMC was telling us heading into the tech bubble or into the GFC. And just for context here, we like to say that when we have fewer than 10 factors flagging red, buying dips in equities still makes sense. And when more than 10 flags are up, it might be a little bit more worrying. So as of our latest update, our global BMC had about 8.5 out of 18 factors flagging red. Those flags are primarily coming from high valuations more than anything, which looks very similar to the past. But what's more worrying to us is that many factors that aren't flagging red yet are just right on the cusp of reaching frothy territory. So that includes things like equity fund flows, for example, and IPO activity, which has been pretty subdued, could be another thing to watch as we go on to later this year.
Interesting. So maybe we're still narrowly in deep buying territory for now, but the market is getting seriously frothy. Will definitely be something to watch very closely going forward.
Exactly. But Beata, let me turn it back to you really quickly before we wrap up. Just given everything that we've discussed, the bull and the bear case here, how are we actually positioned in our global equity allocation? How are we thinking about the markets to the end of this year?
Since start of the war, our message has been consistent: favor quality and with some defensive hedges. And we still see reasons to stay invested, even if gains look narrower in the months ahead. So that means we still like the US market in the global context, paired with an overweight on UK market. The resilience of earnings going forward will be key to watch. And of course, geopolitical developments around the Strait of Hormuz remain the single biggest swing factor for markets. Plenty to watch out for, and I have a feeling that our bull-bear debate will continue. But let's wrap up here. David, thanks for being here today.
My pleasure.
Thank you for joining us today. This episode was recorded on the 26th of May, and I'm your host, Beata Manthey. Our next Research at Citi Markets edition will be hosted by Dirk Wheeler, Citi's Global Head of Macro. Thanks for tuning in. Goodbye for now.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.